All right, guys, so let's jump into it. Today's session is just going to be mainly based on the blueprint of the strategy rather than analysis. We all know that the markets are moving very slow at the moment, so we could analyze a few charts, but I'm just going to keep it short and sweet and just kind of break down the actual strategy rather than looking at some charts. But the next time I do a Zoom on this, I'll make sure to go extra hard on the charts. Okay, let's jump in. Okay, cool, guys. So for anyone that's new to this, this is the Steady Strategy by John Dollery and Starboy. Now, if you are interested in learning this strategy, don't just depend on me. Make sure that you go over to golive.im and you're watching Starboy and John Dollery religiously, because they're the guys that are really going to teach you this strategy, not me. I am just the messenger. Call me Hermes. So yeah, I'm just the messenger, and I've learned this strategy over the last couple months. It's proven to be very fruitful for me. So yeah, I recommend that you get into it. It's the best strategy that I've learned from IML, hands down. Guys, can you just confirm you can still hear me nice and clear? Because I am in my room and the Wi-Fi is not so good here. Okay, cool. Okay, so yeah, I recommend that you start with Starboy, and because he's a bit more, he breaks down the basics a bit better. Watch Starboy's favorite sessions on golive.im, and he's also on live every Wednesday night, and it's technically Thursday morning at 12 a.m. and every Sunday night, technically Monday morning at 12 a.m. So I'd say go through Starboy's favorites, then go through John Dollery's favorites, and while you're doing that, watch their live sessions once you're kind of up to scratch with the knowledge, because that way you can catch some of their live setups. And I think they'll be back on, they'll be kind of resuming from about the 5th of January. Okay, cool. So yeah, watch their favorites. Yeah. Okay, so the objective of Steady. Steady aims to take the understanding of market structure, technical analysis, Fibonacci retracement, and market geometry. So market structure and technical analysis is kind of like support and resistance, all your basics, trend lines, and how the market's kind of moving, so many different things, Bollinger Bands, whatever. And then add Fibonacci to this, which is also under technical analysis, and market geometry. So one thing that John Dollery talks about a lot is numbers, how psychological numbers have a big part to play. So for example, maybe a currency will be near 1.5, and then it will play off 1.5 in a certain direction because it's a big psychological number for the institutions. And also part of this is candlestick patterns as well. So you've got dojis, you've got hammers, you've got all of these different types of candles. And basically, one thing I learned from John Dollery at an event this summer is what candlesticks are essentially the language of the market. So once you can learn the language of the market, I think everyone will agree that if you can learn the language of something, you can understand it and see it in a different light, rather than just maybe looking at the emotions of the market or how it's moving. It's like a language, and you can probably tell how someone's feeling if you're listening to someone talking in a foreign language. But if you can actually understand what they're saying, you can then communicate yourself, and you know what I mean, get the gist. And then once this has been determined, the strategy then applies smart money concepts. Now, smart money concepts, I think, is from Smart Money, which are on IML. And also, if anyone is going to the dinner on the 18th of January, then Smart Money, I think it's the same thing. There's a couple Smart Money guys that are attending the dinner, and they're going to be dropping some nuggets. So put a 1 in the chat box if you're already attending the dinner. But if you're not already attending the dinner, I recommend you do. I mean, the tickets are £20 for a priceless amount of value that's going to be dropped. Absolutely priceless. John Dollery's already confirmed to be going, so the main man for Steady. Chris Derrick for Price Trap, he's going to be attending. They're going to be dropping nuggets. It will give you a chance to maybe network with similar people, or even them themselves. You might get a chance to chat to them. And yeah, I definitely recommend you go. Since I've been with IM, I've never been to anything like this. So what Traders and Empire have organised is pretty mad, to be fair. So yeah, I think I could be wrong, but I think a couple of the Smart Money guys, I know that they're already confirmed to go, and they might be dropping some of these concepts that tie together with Steady as well. So what Smart Money concepts are basically, they look at institutional candles. So what an institutional candle is just basically a buy to sell candle or a sell to buy candle. So when the market is moving, for example, if the market's buying on a daily perspective or a weekly time frame, mainly on the higher time frames, you can find institutional candles on the 1 hour too, but obviously the lower time frames, they're less accurate. So if you can find institutional candles on higher time frames, it's much more higher probability of it executing the way you want it to. But basically what they are is when the market will be moving up a lot, as if it's in an uptrend, and then all of a sudden one candle will just push all the way up and then just absolutely shoot down to the ground. And what basically happens when institutional candles are in play is the market will be pushing back up to a level of liquidity. And what liquidity basically is just money in the market. Is where there's trapped volume, there's trapped money that needs to be revisited. So what the banks will do, and the big institutions that trade huge amounts of money, the hedge funds, all of that, they'll hedge their positions. And what hedging is basically like they'll have buy-in and sell-in positions. So they'll have both types of positions in the market. So for example, if the market had been buying, they were in a buy, and then all of a sudden the market has just sold off, they'd still stay in their position. They wouldn't necessarily have a stop loss, or they'd have it much further down. I don't know, but they'd still stay in one of their positions. So what happens is the market always needs to go back to that position so that they can get out of their positions or place more positions in the direction that they want it to go. So yeah, that's smart money concepts in a nutshell, really. And then also it is areas of displacement. So what institutional candles, they play off areas of liquidity. So what will happen is it will revisit an area of liquidity that that it needs to revisit, and it will revisit areas of displacement, which is where the market needs to correct itself. It's basically displacement is where there's been a huge move up. There's been high volume candles with little to no wick. And the market will always need to recorrect itself because there's going to be a lot of volume within those high volume candles, because they're big candles, and there's been no opportunity for people to get out of trades, and there's going to be all sorts in and around that area. So, for example, if the market's buying and then it sells off a huge amount, and there's sort of like 3 or 2 or 3 or 1 or whatever daily candles of huge candlesticks with little to no wick, then the market at some point in time, and it's not a matter of when, it's not a matter of if, sorry, it's more a matter of when this displacement corrects itself. So it could be months later, it could be weeks later, it could be the same day, but either way, that displacement and the market will have to correct itself back to that point at some point in time. So yeah, that's smart money concepts. Once you can start to spot these concepts, and they all kind of tie together, institutional candles will play off areas of liquidity. Areas of liquidity is where the market will come back to a certain area, and so for example, it might have filled an area of displacement, and then there's an area just above where it sold off previously. So let's just see if we can find a little example in the markets. Okay, so guys, can you see here? If you can see my arrow, someone just confirm that you can see my arrow. But if you can see my arrow, where this pink, the second pink circle is, there's a big sort of buy to sell area there, and so above this pink sort of area where there's been the last buy before the sell, there's going to be liquidity. So there's going to be money above this area. So there's going to be people's stop losses. There's going to be people's buy stops, which is where the market, they want it to continue up further. There's going to be people's orders that they had placed to buy. There's going to be hedge positions. There's going to be all sorts. So areas of liquidity, what the market has done sort of further on down the line is it's corrected itself after this big displacement, where there's been sort of not a lot of retracement. It's just been all red, all selling off, and it's corrected itself back to this point. It's come back just above this area. Sorry, let me just check this. Okay, you can see it. Cool. Yeah, it's come back to that area, and it's come just above the area of liquidity, which means it's collected all of this money. It's collected all of the stops and liquidity, which is money, ready for the next push down. So that's what liquidity is. Okay, cool. So now let's get into the strategy. In terms of the strategy, what we need to do is first we need to do 3 things, and I hope you guys are taking notes on this. If you're not, then just quickly grab a pen and paper to take some notes. But for the strategy, first we need to do 3 things. 1, we need to determine the trend. I think everyone should be able to determine the trend by now. And if you can't, if you still struggle with that, then make sure you watch one of Oscar's basic videos, or one of Bryony's, or one of Des's, and they break it down pretty easily, the basics. So determine the trend. whether it's going up, whether it's going down. We need to determine higher highs, whether there's been higher highs, higher lows, or whether there's been lower highs and lower lows, which we'll get into in a minute. And we also need to figure out, has there been a recent shift in momentum? And we can discover this by looking at the higher highs, higher lows, or lower highs and lower lows. The first confirmation, determine a trend. I'm not really going to go into this too much, but everyone should be able to do it. You can look at this. What I'd recommend doing is start from the highest time frame, so the monthly time frame. Start from the monthly and then work your way down all the way to the 1 hour to the 15-minute, because that way you can take notes on where the market's going on a higher time frame perspective. So in this example, it's going down, but then you can see here in the current market that the market might be going up, and it might, say on the daily, be in a fairly steady uptrend. So you have to kind of get a broader perspective for where the market's going to go long term, and then determine whether you can make a move or look at opening a position on a shorter time frame, or just find an optimal entry for it to continue going in the way that it has been on, for this example, the weekly. Okay, guys. Sorry, I'm just getting a couple notifications. Yeah, it is being recorded. David just asked that on the chat. Okay, so in terms of the higher highs and higher lows, and lower highs and lower lows, this is basically an example of this. I'll quickly jump onto the charts and show you another example as well. But you can see at the top here that there's been a higher, the highest high. This first green circle here, it's been the highest high. It's then come down for a lower low. Does get a bit confusing, so don't worry if you get jumbled up with what they are. But it's been a higher high, and then it's been come down to a lower low. It's then made a lower high. So previously, it looks like it had been in an uptrend. It's then made a lower low than before, taken out this previous low, and then it's come back up and failed to make another higher high. So this would have been okay potentially if it had come and made another higher high, but that's your first confirmation, the lower high. Lower high. That's your first confirmation that there could be a shift in momentum. So then at this point, what you're looking to do is put a horizontal ray where probably at this point, and also where I have at this point as well, when it's made another lower low and then a higher low. And then a lower high. It's then made another lower low, and then it's tried, and then it's made another, and then it's made a higher high, basically. So at this point, where there's been the first pink candle, circle, the market looks like it's shifting in momentum. It's shifting to the downside. But then what has happened is it's come back up. It's broke this previous lower high. Higher low. No, sorry, lower high. I'm getting confused here. But it's broke this previous lower high and it's made a higher high. And then the market has come back and it's made a higher low. So if you look at the last green circle, the market's then come up from that last green circle to break that previous lower high, and it's made a higher high, and then it's come down, made a higher low, and then another higher high. So at this point, we're looking at a potential shift in momentum, but then you can see it's just completely taken all of that out, and it's made another lower low. So one thing that these guys, the steady guys, they look at is the way that they look at the markets. Sorry, let me just get rid of some of this. So they don't look at the markets how it is like this, where it's coming like that and big squiggly lines and coming down, up, down, up, down, up, down. The way that they look at the market is more like this: down, up, down, up, down, up. So do you see what I mean? It's a lot more clear. They don't look at it in all of the little mini waves that it does. They look at it in the big moves that it does and stuff like that. So we'll go back onto here. So for that reason, there's a lot of people going to be looking at the markets on a smaller perspective and not looking at the bigger picture. So they might still be thinking, even after this lower low that's been made again, that it could come back and continue in its uptrend or whatever. But then we can see here that is made another higher higher low. Then it's made another a higher high, and then it's made another higher low, and then it's broken this previous one again. So that's another confirmation for a shift in momentum, because it's broken that first candle, sorry, the second pink circle, it's broken that. So then you're looking at another shift in momentum, and you can see here that it's sort of staircasing its way up. The only thing I can say here is that it looks like it's lost a lot of momentum, so it could be going into consolidation where it is currently sat at, because you can see here that there's been the big impulsive moves, right? There's been a big impulsive. Let me just see if I can edit this. So guys, is everyone still following? Put a 777 in the chat if you're liking it, if I'm giving you a bit of value. So yeah, you can see here that it's come up. Let's make this red. It's making these big impulsive moves up, down, big impulsive move up, and then you're looking at maybe another retracement because it's losing a lot of momentum. It's not as impulsive as it was before in these two first previous waves. Cool. I'm slightly struggling with my throat at the moment, so apologies if it's a bit husky. Also, guys, I'll send this PowerPoint into the. It's an updated PowerPoint into the group chat after I've finished. updated it and kind of added some notes to it. So that's your first, second, and third confirmations. Has there been a recent shift in momentum? And a recent shift in momentum is determined when previous higher highs or lower lows have been swept. Previous lower highs or higher lows have been swept, whether they've been taken out and gone in the opposite way to what it was staircasing its way up to previously. So fourth confirmation. So Fibonacci retracement. If anyone doesn't know how to draw up fibs, then send it into, actually, Bryony sent the video in the chat. It's on Richard and Ben's advanced training. So if anyone doesn't know how to do that, then watch what Bryony sent in the chat. If you can't find it, then send it on the chat and someone will get it for you. But yeah, fibs, what you do is you basically draw the highest from if you're looking for it to go to in a downtrend, you draw it from the highest high to the lowest low. And if you're looking for it to push up, then you would draw the fibs from the lowest low to the highest high. Because then what happens is the market is always going to retrace to certain points, and it always plays around. You can see here that in these areas, you can see it plays around, or it plays off of these areas. So for example, it's come down to 0, and then it's come up to the sort of around the 61.8 mark, and then it's played off, and then it's reversed around the 38.2 mark. The 38.2 is quite a big reversal region. It's then pushed back up, and then it's looking at around the 88 mark. And if anyone doesn't have these settings on there, put a 777 in the chat. If you actually, sorry, put a 444 in the chat if you don't have these settings yet, and I'll just quickly go through them, because these are the optimal parts of points of Fibonacci that you need to have. Let's see. So so you don't have these bits. Okay, so let me just type them out. You don't really need the 38.2 or the 50%. I just have them just to kind of look at them as extra. But the main ones that you want to have are the golden pocket areas. So that is golden So they're actually on the screen as well, guys. So take a quick screenshot if you like, whatever you want to do. I'll just put them in the chat box for the benefit of anyone else as well. In fact, it might be updated. Just bear with me, guys, a sec. Guys, can you see my Safari as well? Can you see when I have Safari on as well? Okay, my bad. My bad. I've been looking at Safari and you can't even see it. Sorry, guys. So yeah, previously I was saying, can you all see it now? Okay, cool. Yeah, previously I was basically saying that these guys they see the market. They don't see the market like this, where it's like in squiggles and sort of going up, down, up, down, up, down, up, down, up, down, up. You get the gist, kind of like that. What they do is they look at the market like this. So big moves up, big moves, kind of like that. They don't really look at the small sort of points in the market. So does that make sense to everyone? They're looking at the bigger moves. They're looking at the market on a bigger perspective. So yeah, that's that. So Fibonacci, you're looking for pretty much to tie in with this strategy. You're looking for moves to come in your golden pocket area. So between the 618%, the 71%, or more optimally, and this is what John Dollery prefers. Starboy prefers kind of the 618 to the 786%. But what John Dollery prefers is he prefers the 786% and the 88%. And he prefers this because the market, this means that you're catching price at a much more optimal area. That means you can have your stops much more tight and you can catch extra pips. You can catch sort of like 20 extra pips, 20, 30 extra pips, and that can make a real difference in your trading. So John Dollery likes to catch the moves at much more optimal areas, really. And it's kind of down to you what you prefer. You might catch sort of smaller moves from the 61.8 to the 71, even to the 786. But yeah, it's up to you as a trader what you'd prefer. For me, from my experience so far, I do prefer it coming into these 78.6 and 88% because it means there's going to be a bigger move down, and it's, again, like you said, you're catching it at a much more optimal entry. And if it is going to go down in the way that you want it to, it's gonna make a big move from those areas anyway. So you can see here, this is a good example where it's wicked off at this area, which also will probably have tied in with like a daily institutional candle where there's been a big buy to sell candle. So you can see here that it's been a buy and then a big sell. So if you had looked on a daily, there would have been probably one big sort of buy candle for this area. I can see here that there's sort of only, there'll probably be how many 4 hour, I don't know, there's probably 6 4-hour candles in one day. So these last 6 candles would have made up that big buy candle, and then the next day it would have just sold off. And so what you're looking for is the market to come back into this area, because you can see here that it's sold off a big amount, but that means that there's been a big amount of displacement to be filled. So again, if you had looked on the daily or the weekly time frame, you would have seen a lot of displacement. You would have seen a lot of just big impulsive moves to the downside. You would have seen not a lot of wick and just a lot of big body candles that just basically need to be corrected eventually at some point. The market's then corrected itself with it's corrected this displacement. And then you're looking for, once it's corrected this area of displacement, it's come to an institutional candle, and you're looking for it to potentially sell off again, which it has done. It's wicked, and wicking is a high. When you see candles wicking, when you see big wicks in a candle, it means it's a high probability chance of the market reversing, because it's people getting out of their positions. It's people pushing the market down. The market is failing to do what it's wanting to do, basically. So if you look at just this chart in itself, usually when there's big wicks, there's reversals all the way along, really. Reversals here, reversals, all the way down. So that's a big confirmation. So the fifth confirmation, institutional candles. They're best found on the 4-hour, daily, weekly, and even monthly timeframes. That's from my experience. On the 1 hour, they can be found, but they're obviously, like I said before, not going to be as accurate. So here you can see an example of a weekly buy to sell candle. You would have been basically looking for the market to come back to this area. And I do remember this trade, we were looking at it coming back. And so the way that you measure an institutional candle, let's just see if we can find one here. Okay, so this is a good example. And what you will do is you'll find the buy to sell candle for this example. So it's the last buy candle before the sell move down. And you'll pull up your Fibonacci tool. You'll draw it up from body to body, not wick to wick, not wick to body, body to body. So from the body to the body of the buy to sell candle. For me, I've got two different templates. So I've got a steady template, that's for the optimal steady fibs, and I've got a 50%. And this is basically what you'll do. You'll draw it from the body to the body. In this example, it's an up candle. So you'd draw it from the bottom, because the open of the candle is always going to be on the bottom for an up, for a buy candle, and for a sell candle, the open is always going to be at the top, right? So hopefully that makes sense to people. And then what you'll do is you'll draw horizontal rays at the open of the candle and at the midpoint of the candle, the 50% mark of the candle. And so what these points are, they're basically points of interest, and they're areas where there's going to be a lot of volume. So there's going to be trapped volume, there's going to be people's orders, people's buy orders, there's going to be a load of stuff like that. So you don't really need to necessarily know why these are the points that you should look at, but it's more just sort of the application of doing it and just trusting in the strategy. But yeah, there's a lot of volume here. So you can see here that when you look at the market as it sort of goes along, that it's been a buy candle and then it's sold off a lot. there's been a big impulsive candle here, right here. The market has then played off this area, so in between this area, right? And again here, the market has again played off this area. That's because people will have closed their positions here, and the people that didn't see it the first time, they would have pushed it back up. The people I'm talking about is like the banks and the big institutions. They would have closed it off. Some of them would have closed it off here. Some of them would have just thought it was maybe a retracement or whatever, and then pushed it back up. But then it's failed again. So they've got out of their positions, and then the market's moved down a lot. So let's say you just spotted it here. Even just from the open of this candle, I mean, guys, just in a short space of time, in a week, this is Euro GBP, so it's been moving a bit weird. Oh no, this isn't 03. But yeah, I mean, just in a week is gone 170 pips, albeit this was in 21st of July 03, so in 2020 it's going to move a lot quicker. But you can see how powerful these institutional candles are. And you can see again here that it kind of played off at this point. So yeah, that's just an example. Let's see here. Okay, this will be a good example. So you find the buy to sell candle. Pull up your fib. Draw from the body to the body. Mark up both the open of the candle and the 50% because that's where the most volume is going to be. And then you look here. And what has happened here, guys, is there has been a lot of volume. There's been a lot of liquidity just above this area. So there's going to have been people's stop losses, people's buy stops, stuff like that, just above this area. Right, so there was money above this area. What the market has done is it's come down, it's had a shift in momentum, and then but it's displaced itself, so it's always got to come back to this point at some point. So this would have been the biggest area of displacement, and that got filled. So this got filled here, right? Even just here, where the displacement has been filled, it's then filled it almost to a T, and then just shot right down again. But just for this, just for the purpose of this, there's been liquidity above this area. The market has taken out that liquidity, so it's come a little bit higher than previous. And once it's taken out all of that money, all of the money that is above this area, it can then move in the way that it's supposed to. So, I mean, this went 1,000 pips, albeit you might have held it for a bit longer because this is on the weekly, but you can find these kind of moves on most of the, well, on all of the higher time frames. So this is just the weekly that we're looking at, but even on the weekly, you can see how powerful it is. If you had got in at the 50%, even if you had just held it for 1 week, 170 pips. A month, 350. And guys, this is passive income. This is money that you don't have to work for. You can literally just know that it's going to do what you want it to, and let it do it. Let it do its thing. I know I said I wasn't going to look at the charts much, but let's see. Okay, yeah, you get the gist of institutional candles. I won't go on the charts too much because I know we're I'm aware of the time. But so that's the fifth confirmation. Sixth confirmation that we're looking at is measured moves. So the market will always move in waves, and like I was saying before, these guys, they don't look at the markets in mini waves and stuff like that. They just look at one big move up, the one big move down, the one big move back up, back down. And so within these moves, there's going to be a lot of mini waves. There's going to be a lot of stuff like manipulation and stuff like that. But if you're looking at the bigger picture, that stuff shouldn't really matter. And what measured moves are, it's basically the market's always going to have moves. And the moves 9 times out of 10, and this is something that Chris Terry actually taught Starboy, is that it will move up in a certain direction and it will move down in also a certain direction, but the moves up will be in moves greater than or equal to the previous, and the retracements will also be greater than or equal to the previous. So let's just see if we can find some of that here. So the market's moved down, right? And then if you copy and paste, the move is, greater than or equal to the previous move. I mean, even just for this, it's pretty much equal, right? You can see here how it's pretty much an equal move. And if you want to go there, it's greater than. But just where it retraced properly the first time, it's near enough exactly the same. So when you take into account institutional candles, when you take into account Fibonacci retracements, and then you look at these measured moves, this is when you can start to figure out exactly where your trades are going to go. So the institutional candles and the fibs, they help you find your best entries, and when you look at measured moves and other stuff like that, you start to find where you can exit the trades and where you're looking to take your trades. I mean, determining the trend, higher highs and higher lows, so that's just the basics, and it basically helps you to determine whether the trade setup is going to be any good to move forward with the fibs and the institutional candles and stuff like that. So the 7th confirmation and the final confirmation, we've talked about it already, is displacement. And displacement, as I said previously, is areas where the market needs to correct itself. It always needs to correct itself after big impulsive moves. So, for example, here, this will be how you look at displacement and how you measure it. Can you see here how there's been this huge buy candle, the green candle, that has left a huge area that needs to be filled. So just there, you would have sort of had a big displacement area. But then what has happened is the market's come back, filled the displacement somewhat, but it hasn't fully filled it. So there's been displacement filled, but not fully. So you can see here how there's like sort of wick to wick. There's still this area that still needs to be filled, even probably a bit more than that. If we're just looking at it like sort of currently, you would have had it sort of from about here to up here maybe. So this is sort of areas where you're looking for the market to come back to correct itself. And if you can find sort of institutional candles around this point, if you can find Fibonacci areas at this point, then you're looking at sort of extra confirmation basically. So guys, before I go on to sort of like summarizing this presentation, is there anything anyone wants me to touch on again? Is there anything anyone wants to go back over or anything like that? Let me know. No, is anyone? Anything at all I can go back over if need be. Okay, so yeah, Simon, institutional candles and yeah, fibs help to find your best entries, and then measured moves, sort of displacement, institutional candles, and fibs. They all help you find best entries, help find your best entries, and stuff like measured moves. That helps you to find exactly where your entries are then projected to go, how far they're projected to go, and stuff like that. And the moves are always going to be equal to or sometimes greater than the previous moves. So, for example, if the market has gone up, if the market's in an uptrend, the market has gone up 180 pips on the previous move, it's then retraced 50 pips. You're looking to get in around this area of retracement. It's always best to get in on the third point in a move. So I don't know if everyone should have gone through this, but I don't know if everyone remembers Elliott waves in when they're learning in the academy. But basically, what Elliott waves are is you've got. Sorry, let me just make this a bit more. Yeah, so So the market's going to move in waves from point 0 to 1, 1 to 2, like this. So let's say on this first move, it's been 180 pips down. It's then retraced 50 pips and then come back down. Always on the second or third move, that's going to be your highest probability of execution. So probably you're looking at the best point to get in would be around about there. So if the market's retraced 50 the first time, and then you're looking at it, it's retraced 50 the second time, and then you can see sort of by judging by the language, which is the candlesticks and the patterns that are happening. Let's say you're seeing dojis and hammers and reversal candlesticks, and you're also seeing big wick rejections, stuff like that, and the market's sort of gone 50 pips like the last retracement, then you're looking at potentially another 180 pip move to the downside. Okay, Simon, does that answer your question? So basically, in a nutshell, institutional candles, displacement, and Fibonacci's, they help you determine your best entry points, and measured moves will help determine exactly where your entries are going to go, how far they're going to go.
Yes, me left sitting there. Me left one back la bill. Oh, yeah, for your husband.
Guys, can you mute your mics?
Got plenty. Holy.
Sorry about that, guys. Okay, I have a question. How would I know? Okay, I'm gonna officially stop the recording, guys, but I'll answer any questions and I'll stay on to answer anything. So thank you all for tuning in, and I hope you got some value from this. And make sure you go onto Starboy's sessions, go onto John Dollery's sessions, make it your religion, and you will be successful in this strategy. It's quite an advanced strategy. So yeah, just plug into the value that gets dropped by Starboy and John Dollery. So have a very happy new year, guys. I hope you've got all your goals set for 2020 for the next decade. The next decade is going to be crazy. It's going to be monumental, and yeah, use the next couple of days to sort of reevaluate things, recharge, and 2020 is going to be a big one.